Yes, it's up until now, it's pretty much been a case of the dog that hasn't barked, if you like. There's been very little in terms of impact on the first quarter results that we've seen from tariffs, because obviously the major announcement took place after quarter end. But what has been a bit surprising to us is that even in terms of forward-looking guidance, there's been very little changes in terms of guidance from the banks. I think it speaks to the uncertainty of this environment, but we are concerned about the impact of tariffs and the global realignment of trade on the asset quality, or credit quality, I should say, of the clients of the banks.
There clearly strains being felt and starting to emerge, some fractures thanks to the tariffs. But one bright spot has been investment banking. The huge volatility that we've seen on markets has brought in huge volume, and that's benefited banks with investment banking businesses around FX and equities. What do you think that means for the short, medium and long term in terms of positioning? Is it now welcome to have a bigger footprint in investment banking?
Yes, it has definitely been a bit of a sea change. It hasn't been that long ago that investment banking was seen as a liability almost for banks, and a lot of European banks actually scaled down their investment banking franchises. I think what one needs to bear in mind is this is very much top of the cycle revenues that we're seeing for the investment banking businesses, especially equities trading has really benefited from the volatility. I mean, I think for the rest of the year, or at least the next 6 months or so, we can expect volatility to remain. So the outlook is still good, but at some point in time, it is going to start normalizing. And we've seen this movie before. It quite often happens that banks start to expand and invest in the investment banking businesses right at the top of the cycle. And then when markets turn again, there needs to be a rationalization in costs.